All right, welcome back to another installment of uh, Expert Interview Tuesday. And with me here today again, I do have Brian Kropp rejoining us. Now, the last time Brian was here, he was focusing on habits, and we were talking a lot about not only the fact that his financial side and his experience there, but also his Taekwondo studio and how he's got his school open as a result of a lifelong habit of just continued discipline. But today we're going to focus on one of the other areas that Brian is an expert in, and that's all around life insurance. And so we're going to hit it from a couple different angles. So first off, Brian, I want to thank you for being here and appreciate you jumping back in with me again and sharing what you have. And so as we get started, Brian, I know that you and I've talked about a couple friends of yours over time that made some choices and resulted in you deciding that, wanting to give some tips for the folks here about when they should get life insurance. So when do people need to be insured with life insurance? Is it once they have enough to protect, or is there a better time?
Good question. So you and I have spoken, and being in the life insurance industry, typically what happens is companies say, hey, get used to your friends and your family, talk with them, because obviously life insurance is an important topic. And so I did that and had a conversation with several of my friends that were around my age, at the time, mid-20s, so really young, from a job perspective at least. Most people work till they're 60. And I found some friends that were insurable, so they wanted to get protection for a number of different reasons. And then I actually found a couple of friends of mine that were uninsurable. So what that comes down to is people have this preconceived notion that they're always going to be healthy, they're always going to be in good shape, nothing bad's going to happen to them until it does. And so these friends that you and I have spoken about, they came back and the insurance company says, you've made some poor choices in your life. You're too high of a risk for us right now, so we are not going to offer you any insurance. Well, with the life insurance industry, once that happens, any new applications that you fill out have to have a little check mark that say, I was turned down for life insurance and here's why. So now other companies that you might go for go, why were you turned down? And what happened for them is all the companies said, nope, we're not going to go ahead and insure you. And I was able to go through about 60 of them. So not just one or two, but through a number of different companies that all said no.
Yeah. And so it can be, one, the risk factor, but it can also come back to, you, I think, touched on it a little bit, is you can't guarantee that your health won't change. And
yes.
So some of them can be choices you've made, but others can be things that happen and you suddenly say, oh, wait a minute, I want to make sure that my family's protected now, and you have other issues going on, right?
So I'll give you a great example of an individual that I did not sell insurance to. Was speaking with her and her husband, and they made the comment of, we really don't think we'll ever have children. So from a generational standpoint, we don't think we'll need life insurance. Okay, well, long story, we flash forward a few years, and guess who's pregnant? And so it's the idea of you don't really know what life is going to throw at you, and now they want life insurance. Well, fortunately, she's still healthy enough that she can get it, but she's now a few years older, it's now more expensive. So unfortunately, unlike driving an automobile where you turn 16, you get the keys, you get the license, and you're a horrible driver because you only have a few months experience, your auto rates are a little bit higher because of that. Life insurance works the other way. You're younger, you have a much longer period to live, so your rates are lower. As you get older, they just go up and up and up. So, not a horrible thing for her story, but now she has, 3-4 years behind the curve as far as having that all in alignment.
Right. And I know that you and I both ran into people who life took a turn unexpectedly and they suddenly were no longer around and their family was left without any of the protection as well. And so, I think the point here is start young, right?
Start young. So there's two kind of stories that come to mind. One is, do you know who your great-grandfather is? Most people like to say, no, I don't know who my great-grandfather was. And well, so the analogy, the punchline is, well, that's because they didn't leave you any money. they left you some money, they would probably, more likely to know their name. Not that that's why you want to know them, but that certainly is a big moment of, oh, wow, I have some extra because, my foremothers thought a little bit ahead of it.
Mhm. Right. And so, that's a great example, and it is passing on wealth generationally as is one reason for life insurance. Now, you and I've also talked about another way to use life insurance,
Mhm.
and it's an example where, there's maybe reasons to start as an infant with life insurance.
Yes. So as an agent, that's actually one of my favorite policies to share with people to get them approved on is for minors. So anybody under the age of 18. And the reason is because they fly through underwriting. Because they're so young, they typically haven't developed any illnesses or haven't developed any poor habits such as smoking. And so they just fly through underwriting. The insurance companies go, you're probably going to live a long time. So we have a long time to hedge our bets to make sure that you're insured. And so because of that, there's some really unique ways that you can use permanent insurance to maybe pay for college or for, like myself, open up a business. And so it's more than just the death benefit passing on generationally. There's kind of this stigma, especially nowadays, with individuals going, it's that greed and that wealth transfer. Well, that's only a small fraction of it. The majority is really it goes into what you and I talked about last time about habits and being responsible.
Right.
And so if you have a family, if you have a business, if you have a life that you want to create for yourself, permanent insurance is a way to kind of guarantee that that life will unfold, whether you're here or whether you're not here. And then you can go into other more risky things like opening the business or an investment or whatever it may be. But really, what I've come to find the permanent insurance does is by building that cash value inside the policy, is because that's contractually guaranteed in some contracts, that life has to unfold. As long as you're paying the premium, that life has to unfold. The insurance companies have to do that work for you. And so that takes a lot of uh, anxiety off of the contract holder themselves.
Right. And you used a term there that I want to go back and talk a little bit about. You talked about permanent insurance. And so
Mhm.
in life insurance, there's different kinds of life insurance. And so if you just touch on some of the different life insurance types of life insurance and where they're used maybe.
Sure. So give you the sweet and condensed version here. So there's two major types. One is what they call term insurance, and that's the one that's great to get when you're young and healthy and you only want to pay a little bit. And the reason is because you can buy a bunch for a small premium. And so you can get what in the industry is referred to as a human life value, which is drastically more than most people give themselves credit for. Because you have 40, 50 years to work, well, that's 40, 50 years of income that you should probably protect for either yourself, for your family, for your descendants, for your business, whatever it may be. And so that's why term insurance is really good, is to get that big number of coverage so you can make sure that your responsibilities are taken care of. The second type is what they call permanent insurance. And there's, to your point, there's 80 million different types of ice cream on this one. The main two that are out there are things called whole life and something called universal life. And essentially, they're trying to get you two different things. Whole life is the grandparent insurance, and it's designed to have that life unfold that I talked about earlier. The universal life gives some of that control mechanism back to the client in order to adjust their premium up and down, in order to adjust the death benefit up and down, and a number of different levers that you can pull. What I found in the industry is most people need structure. And so getting them the cheap term where they can get the coverage in first place and teach them habits allows them to do other things. The second side is to really get that permanent insurance at a smaller level and build that over time, whether it's for, like we talked about earlier, the college planning, or maybe even just liquidity, like I used it myself to start a business, or maybe that's your lifestyle fund. People have this concept of, I need my emergency fund of $1,000 and that's it. Everything else I'm going to spend, or I'm going to shove in my 401k or whatever retirement plan. And unfortunately, that's a very limited uh, mindset, limited scope. And so it really comes down to, no, I'd like the ability to go on a 1 month cruise in my 30s. Well, very few people in their 30s can do that without some kind of added say, family support or winning the lottery. But by teaching clients habits about turning that permanent insurance into more of a savings liquidity vehicle that allows them to really not just have it shoved in a savings account somewhere earning next to nothing at this point. It allows them to actually grow it a little bit, but without the risk that's associated with your traditional, stocks and bonds or other investments.
Right. And, Brian, you really hit on a key point here that I'm going to step back to that, in my case, had I had someone who was giving me the advice to say, use your a whole life or universal life as a vehicle towards, protecting potentially your retirement or your savings, something down the road that allows you to have access to that money, instead of saying you need to put everything into your 401k. I, at the point of taking early retirement at 53 years old, would have had a much different financial picture for myself. And so part of what you're talking about is what got me started down the path of wanting to get this education out. And so I appreciate your pointing those out, because I think that that's really why I want to make sure that everyone has a better understanding of the investment vehicles, and that life insurance, in fact, is one of those vehicles. Now, with every life insurance policy, there are a variety of different additional riders that you can put on those. And, I know that there's one actually even on the term life that allows you to have the cash value protected. It's an extra rider, you pay a little bit more, but one of the disadvantages that I see in term insurance is that once your term is up, everything you've spent is all gone. Yes. Whereas there is some ways to even still use term insurance to protect what you've invested there, to allow you to then use that in another way should you outlive the term of that policy, right?
Yeah, so give you another quick story. So when you think about Las Vegas, the biggest gambling city in the country, and how much money that city, those casinos make. And so you take arguably blackjack, which if you play it perfectly, you have a 49% chance of winning. And so the house has a 51% chance of winning. So that 1% difference, that 2% difference, Las Vegas is created, right? And term insurance is very much the same way. The insurance companies only pay out 1 to 2% of those policies. So they have a 98% chance of winning, to your point earlier, as far as the clients paying those premiums, not dying, which is a good thing, but then having nothing to show for it at the end of it. So while it's a great protection vehicle, doesn't work out so well for building wealth. And so what it comes down to is that's where you have permanent insurance, and that's where you have a lot more conversations with people. And so what you were talking about as far as riders with permanent insurance, because there's that cash value inside of the policies, you actually have some that you can use like a savings account. You can actually take a loan from it. You can take a withdrawal from it. But what that lets you do is gives you options. And that's what you described earlier about early retirement, is people set themselves up with 1 or 2 different things, and that only gives them 1 or 2 options. Well, as we go in life, all options just limit, right? Whether it's because we're physically not able, we're mentally not able, family moved away, whatever the conversation is. But we want to make sure that we maintain that options, maintain that independence, and maintain really our abilities to live the life we want to live. And that's where those riders come in. So I'll not to highlight them, but there's a company called Transamerica, been around for 100 and some odd years, and they actually have a term life insurance contract that has what they call living benefits. And so this is available in your permanent policies as well as many term policies, but this covers the 3 major areas of while you're still alive, which is what they call chronic, critical, and terminal illness. So what those mean is essentially you were in an auto accident, that's your critical, you're in the hospital. Your chronic is a little bit more long-term, and then your terminal, of course, well, you have 2 years or less expected to live. And in those instances, this term insurance can be used while you're still alive. Maybe it's to pay the medical bills, maybe it's to take your family on a cruise, maybe it's to just not have to work and then sit back and go through the treatment you want to go through, live the life on your terms.
Yeah, Perfect, and that's a great example of talking through those living benefits. One of the other things that you pointed out as Transamerica, and they're just one of many, has been around 100 plus years.
Mhm.
And one of the things that you see, and I know one of the things that when you talk about life insurance is that they have some restrictions and requirements when it comes to having the money available to pay out for their policyholders. Whereas, I know back in the Depression, the ones who continued to exist past the Depression were not the banks, but actually life insurance companies.
Yeah. So when you think of any big major city, New York, San Francisco, of course, the big two on the East and West Coast, but who owns the biggest buildings? And the gut answer is usually banks. And they have some big buildings, but the biggest ones tend to be owned by insurance companies. Well, why is that? Well, it's not that they're greedy. That might be a small portion, but what it comes down to is that they have to think very long term. They have to think not just this next year, this next quarter, but especially the mutually held ones have to think 100 years, 200 years. What are we going to be able to do to pay out these policies? And so you end up with a much different management style and a much different thought process on how they operate their business because they have to. That's their industry. That's what they do.
Yeah. And so, basically what you're talking about, what kind of the point I think I was making as well, is that when you think about insurance companies and life insurance, your investment there is actually very well protected.
Mm-hmm.
And so that as I know that there's an indexed universal life product that means that your money doesn't even lose money in the down years and it gains money on the up years. And so there are ways that you can continue to protect, and that's an example where you're looking towards retirement, even building out your retirement. Now, one of the other benefits I know is that there's also, since it's life insurance, any of the money you're taking out there is actually tax free, right?
Yeah, so the way that it works with either policy, but it's money that you put into it has already been taxed. It's already money you've earned from working, from however else. And so it grows tax deferred. And because it's in the contract, as long as it's set up properly, you can actually then withdraw it up to how much you've put in. Or to your point, you can actually do a loan with it. And then you do pass, whatever is left gets passed on to your heirs tax free. It is an insurance vehicle, so because of that, there's no taxation on it at the moment. And there's all kinds of course, bills being passed in Congress that try and take that away because, oh, well, now you have that top 1% passing everything. But in the reality, it's the bottom 99% that use that so much more effectively. And it's so much more of a need to pass on without that taxation. And so whether you're looking at the death benefit or whether you're looking at that cash value in those permanent policies, there are some significant advantages to framing yourself to where you have control over the taxation, not the government. And you want some that are in that sphere and some that are not. But that goes into really people underestimate what they need and what they want. And so that was part of my conversations with my clients was it's not just your emergency savings and then retirement. You also kind of need this middle bucket of the fun things in life or the good things in life or the college or whatever it is. And that bucket is what I found really good to use as an insurance vehicle. Not in all cases, but that's a good just kind of general statement. It's a great middle bucket. Helps you with the small emergency fund bucket as well as helps with that retirement bucking like you were talking about earlier.
Right. And as you mentioned college, I know I saw a example that you put out one time that talked about how investing into one of the permanent life insurance products for a period of time allowed the student to use that for their college education or had a lot of choices at that point.
Mm-hmm.
And so you want to touch on that example real quick?
Yeah, so obviously that's a changing industry as far as how you finance college. There's, of course, government loans, or you can use it your family's wealth, or you can take loans out of banks. There's any number of ways to finance college. One of my personal avenues that I enjoyed talking with clients about was once the mom and dad are taken care of as far as their insurance needs, their savings, their how they're on the right path, is really looking at their children. Children typically are under 18, and it's great when they're really young. You can actually do a policy for a minor, which is a permanent policy, and because of that, well, they're not even going to touch it until they're at least an adult, and the parent retains complete control of it. And so what happens is you end up being able to create this cash value in this policy that can then be used for, a high school graduation trip around the world. It can be used for your traditional four-year university. It can be used for a junior college. It can be used for a trade school. It can be used for starting a bit, whatever it is, because there's no restrictions, unlike a 529 plan or something else. Now, 529 plans have their place. Some of the other college-specific vehicles have their place. But what I found is, especially starting young enough, because of those guarantees that are built into insurance, you don't have to worry about the market going up and down like you would in, say, a 529 or a mutual fund. Those might gain more money than the insurance contract, but that's the key phrase, might gain more money in that. And so when you look at the insurance side, it's a little bit more guaranteed that it will, especially with the whole life. The universal, the indexes are really great vehicles to maybe outperform. And that's where you want to talk with a qualified advisor to find out, okay, how much risk do I want to take? And so what I found has been, because of the way that we do investments, as far as I take more risk when I have longer term, and I take less risk than I do if it's tomorrow that I have to pull that money out, right? So that's the same done with retirement. It's the same done with the college planning. So if I know I'm going to college tomorrow, I probably don't want to take a big risk with the money that I'm going to use to pay for college. Would you agree?
Absolutely.
So and so would I, which is why I said it, right? So looking at it, the insurance, because it's actually planned out over such a long period, and there's so many guarantees associated with what the value has to be, and then you win if extra things work out, like the insurance companies we talked about earlier. So you actually can end up with a better return overall than you can, say, investing the 529. Not that the 529 won't underperform it. It might not, but you don't have that anxiety, don't have that risk associated with the insurance that you do with the mutual funds, the 529s, the stocks, the bonds. So it all goes down to, what is your own personal investment philosophy, and more importantly, what's your internalized wealth building philosophy.
Yeah, absolutely. And so, I know we've touched on a whole bunch of different topics today, and I'm likely piqued some interest in people around any one or a number of those areas. And so if they wanted to reach back out to you, Brian, get some more answers, maybe they're saying, okay, yeah, that's me. I want to make sure I'm protected. How can they best get a hold of you?
So two ways. Number one, because I find most people like to be able to really spell it out, is going to be email. And so giving you my kind of personal business email, which is just my name at Gmail. So Brian, Brian, F as in Frank, and then Kropp for Kropp. And that's at Gmail. So brianfkropp@gmail.com. You're welcome to email me any questions. And then from there, we can look at, say, a phone conversation or a face-to-face. If there are questions, of course, you can always reach out. And I'll go and give you my cell phone at this point, which is 916-337-2336. And so if what we've talked about is, speak some interest, or you have questions about what you have, as you know, I've shared a little bit about some of the clients I've met that were told, oh yeah, I have this one thing and it does this. And in a closer inspection, it does not do that. So there's a lot of agents out there that are taught one thing, and not that it's incorrect, but it's not the whole truth. And that's really where clients end up into situations down the road.
Yeah, and that's why, Brian, I wanted to make sure you're here. One, giving a lot of good, valuable information to those who are listening. Maybe they're parents of young adults, or they're young adults getting ready to branch out on their own. Wherever they are, I know that you stand highly behind your studies. You just didn't get the information from one person. You really have understood the industry and are continuing to grow and learn along the way, just tying into a lot of the habits and the disciplines we talked about the last time you were here.
Yeah, and I think that's important for the viewers to understand is that there's a lot of different types of life insurance out there, like we talked about earlier, and unfortunately, a lot of agents just aren't versed in all of it. They get kind of told one thing, which is great from a teaching standpoint, but they never explore the rest of it. And my story I shared with you, I was in the industry for a little over a year and started asking some questions that I wasn't getting good answers to, and that led me to Pacific Advisors and receive some of those answers. And then from there, everything else just started clicking to answer all those questions that I wasn't getting with that original firm. And there's a lot of agents that just don't take that much care, or they don't take that much time, I guess I would say, because they're too busy trying to make a living, right? They're too busy just trying to make that initial sale to get you covered, get you that term insurance or whatever it is. And so you really need those people that have probably been in the industry a little bit longer, but you also want multiple pieces of advice. And if you notice that you're missing some information, probably best not to go with that person.
Yeah, well, and I think you've hit on a number of different things and questions that people can be asking. And so maybe they're already with an agent and they have not necessarily, they don't feel like they've heard the full picture. I'm sure you'd be happy to help look at what they've got and give them, an insight into, do they have, is what they've got solid, or do they need to look at other options?
Yeah, and that's what I tell a lot of my clients is, look, your advisor you might already have 8 out of 10 things really good in place. But what about those other two, or what that other one? And that's really that fresh perspective. And even myself as an agent, I have my own financial advisor. I use an individual out of my office that, because I'm not impartial to it, I know that I have my own emotional attachments with things. I need him to be like, okay, Brian, here's what you need to do. And intellectually, I know that. And if I were to be coaching myself, I would have that same exact answer. But it's different coming from him than it is coming from me. And that's why I pay him the little bit of money I do, is because I want to make sure that he keeps me on the right path.
Yeah, absolutely. So, Brian, I thank you so much for being here. I know you've given a lot of great information. So, again, we've got your email address, brianfkropp@gmail.com, and as well as your phone number you gave out. Go ahead and give that one last time if someone's saying, I just want to make sure that I'm covered properly, or I actually know I'm not covered at all, and I'd like to explore what I might need to be looking at.
Yeah, so email again, Brian, Brian, F as in Frank, and then Kropp, Kropp as in Paul, @gmail.com. And then, of course, my phone number, 916 area code 337-2336, so 2336.
All right. Well, great information here, Brian. I appreciate your time here today. And I'm sure that those who are here watching are absolutely appreciating it as well. So I look forward to talking to you again. You have an amazing rest of your day.
You as well. Thank you, Erling.
Thank you.